Hello and welcome to Banking Frontiers Live. And we are here for another great conversation in the area of wealth management today. We have seen a lot of upsurge in the stock markets, in the wealth management, in the area of investments, and we are here to understand where is this leading to? Where is the global Indian investing? Where is the family office investing? Where are the HNIs looking at the trends to invest into the global as well as the local market? What kind of risk management is taking place in this sector? So these are some of the interesting compilations that we would have from our discussion with none other than Mr. Amit Goel, who is the co-founder and CEO of Pace 360, which has been one of the forward-looking investment organizations in the country. Welcome, Mr. Amit Goel, to this wonderful conversation.
Thank you, Mr. Nair. Thank you so much for giving me this opportunity and for having me on. Thank you.
My pleasure. Absolutely a great pleasure to have a luminary like you with us. While going on to this wonderful world of wealth management, we have seen a strong upsurge in the Indian market, a lot of interest happening in the foreign investors in the Indian markets as well. Reading all this kind of currents from the global scenario, what kind of market trends can you share today for the high net worth individuals and for the wealth management customers?
Thank you, Mr. Nair, for the question. We are basically a macro top-down asset management and wealth management company. So, we obviously have a different way of looking and approaching the investments for our clients compared to the traditional bottoms-up approach, which most of my peers in India have. So, in macro top-down, we try to identify where we are in the macroeconomic cycle for different asset classes, for different geographies, and for different economies, and for different sectors. And based on that macroeconomic analysis, and that macroeconomic analysis itself is an amalgamation of economics, finance, behavioral finance, anthropology, technology, and as you mentioned, geopolitics. And then based on that, we are then in a position to advise our clients which asset classes to be overweight on, which geographies to be overweight on, and then within the asset classes, you may have, for example, in equity, you may have value, you may have growth, you may have large caps, you may have small caps, or you may have sectoral kind of products. So then finally decide which sectors, which theme of the market, large cap versus small cap, growth versus value, momentum versus defensive, which theme looks more attractive, and then decide finally how to allocate the entire money the client trusts us with, how to divide this money between different asset classes, keeping in mind the risk profiling of the client and keeping in mind their investment needs and everything which is part of this risk profiling process. Post the GFC 2008-9, we have seen 14, 15 years of amazing wealth creation across the global markets. And particularly equities, of course, as an asset class has done exceedingly well. And even within equities, not all geographies have done equally well. So we know that US has done extremely well. India has done very well. Japan has done well. Parts of Europe have done well. But for example, UK equities have not done so well. And we know that Hong Kong and China have not done well at all. So while a lot of wealth creation has happened over 14, 15 years, but some geographies have done better than the others, some sectors have done better than the others. And where we see the world right now is that we believe that we are in the late stages of this boom cycle, which started post the GFC in 2008-9, which was, of course, interrupted by Chinese devaluation in 2015 and then interrupted again by COVID in 2020. But by and large, we've seen 14, 15 good years for wealth creation, for risk assets, for economies in general. And but we believe that we are now in the late stages. So probably and what we are seeing among smart money and we are seeing among large family offices is they are attempting to de-risk themselves, and they are attempting to preserve some of the profits which have accrued to them over the last 14-15 years. So they are taking money off the table, they are putting more money into fixed income, they are putting more money into precious metals, because you know that precious metals and fixed income, they have largely underperformed in the last many years. But in the process they are trying to de-risk themselves, they are trying to protect the profits which they have accumulated, and many of them realize that all times are not equally good for different investments. So they realize that after this euphoric rise in equities, there would come a time of subnormal or subpar returns in some of these asset classes which have generated huge returns over the last few years. So they are in the process of cocooning themselves from and protecting themselves in case a recession happens, in case a bear market happens. They want to preserve most of the wealth that they have created and which they have invested over the last many years.
Interesting. How do you see the investors' preferences or taste in all these new asset classes like cryptos, emerging asset classes of tokenization or land or anything other than that of the stock market and equity markets? How has that been an offtake amongst the customers in your experience?
I completely agree with you that a lot of these new asset classes have emerged over the last 10, 15, 20 years, which were not even recognized as an asset class, or they didn't even exist. For example, you talked about tokenization of real estate. We now know that in some parts of the world, particularly in US and the Western European countries, you already have that process at a very advanced stage where you could even invest a very small amount of money. You could even invest $1,000 or €1,000 in a real estate asset, which has happened through either REITs or it has happened through tokenization. So in India, for example, REITs have been they have been now in the scheme of things for the last about 7-8 years, but we haven't moved much on the tokenization part. But I think attempts are being made where people are converting real estate into digital assets, and you could even put in 10,000 rupees in a large real estate and become a very tiny owner of that large piece of land or a large piece of property. But broadly speaking, whether it was art or it was wine or even private equity 15-20 years back was not such a commonly heard term, particularly in the emerging markets. In US, of course, we know that private equity has been around for almost the last 30-40 years, but we have seen these asset classes emerge over the last 15 years, whether it is private equity, or it is this fractional real estate, or it is art, or it is wine, and so on and so forth. But I would still say that these trends are at a relatively nascent stage in the emerging markets. And we interact with a lot of family offices and a lot of ultra HNIs. And I can safely tell you that while private equity is today anything from high single digits to as high as a 20% part of the portfolio of these many large family offices and even sovereign funds and endowment funds, a lot of them have invested in private equity. And as far as crypto is concerned, again, what we have seen is that large family offices do not have a big presence in crypto. Crypto, I would say it's a tiny fraction. Art wine, again, a tiny fraction. And some of these digital opportunities like real
Tokenized.
estate, which is tokenized, I think in the emerging markets, that's still not very big. But if we see the global trend and if the trend comes from the west to the east, then chances are that that would also become relatively more commonplace over the next 5 years.
Super. That's a wonderful encapsulation of where the market is going and what kind of opportunities you see in the market. When the world is investing into India as a market and you see so much of euphoria in the market and upsurge in the market on one side, what kind of global opportunities has been the Indian investment segment or Indian HNI segment or family segment looking into?
Family offices do have global investments one way or the other. One good thing that has happened, Mr. Nair, is that you need not convert your rupees into dollars and take your money out through LRS or any such scheme to invest in global assets. Today, you've got many global assets listed in the Indian markets for the Indian investors where you can invest your money in rupees. The end investment is in dollars, but you can invest your money in rupees and there are no limits. For example, in LRS, we all know that there is a limit of 250,000 per individual, $250,000. But here there are no limits. So you could invest in, let's say, S&P 500 ETF, NASDAQ, there are some European investment products, there are some China, Hong Kong based products. You could invest in them in the Indian market. You could invest even in US treasuries in the Indian market. There are some funds who are doing that. Whether you invest the money through the global markets or the Indian market, the goal would essentially remain the same. So even that is part of the dollarization process for the Indian investor. But having said that, I know that many of my family office clients have taken out money overseas for investments into real estate, for investments into direct stocks in the global markets, investments into private equity space in the global market. So all that has been happening, and the mode of operation has been either through the LRS route or many of these family members residing in an offshore place. So they have part of their wealth offshore as well through the non-LRS route. That is how they have invested. And plus, now there are some ways which RBI has liberalized this process where some of the large family offices they are setting up their family office in Singapore and Dubai, and there are certain clauses which the RBI has opened up through which you can take your money even apart from the LRS limits. So most of them do have a global strategy. Most of them do want to have part of their wealth overseas. They do not want all of their wealth to be denominated in rupees. And there are, of course, certain asset classes which are present overseas, but those options are not there for the Indian investor. So we see that increasingly investors are doing that.
Interesting. That's a great perspective to know where the money is going to, or at least the people are looking into the newer markets geographically, especially into the underperforming market to get a better value in the near future. Especially when you look into the macro top-down approach, you have so many parameters to consider. So how do you actually ensure that now as a wealth manager, you have to take a look at all these 500 different aspects? You will have definitely access to all the Reuters screens and Bloombergs of the world, for instance. But still, how do you make sure that you do a very interesting compilation of all this together and derive into the right kind of advisory for the customers?
Today, what has happened is that many of these softwares and tools that you spoke about, Reuters, Bloomberg, and the like, they have gone a big way into AI. Bloomberg Terminal, not only do you get raw data in the form of economic data releases which are happening all over the world, they've done some programming and they've got some tools through which you can set up your own parameters, that something comes to your attention as soon as it satisfied a certain set of conditions. It is not humanly possible. On a daily basis, we would get terabytes and terabytes of information. So, for a human mind to completely assimilate all that raw data and to be able to process it in real time is sometimes not humanly possible. But today, fortunately, using AI and technology, we have inbuilt tools which help us to process this data, assimilate this data, give us alerts when something becomes very noteworthy. If something is within a certain limits and you know that it doesn't move the needle for any asset class, then that thing would not come to us in the form of data to be processed. And today, using AI and technology, we process so smartly that all these hundreds of terabytes of information which is being thrown at you on a real time basis, 24 by 7, practically 365 days a year, you could now, your decision making process can be a lot better.
Interesting. I think you have given a very good synopsis about, on one side, how the market is moving, on the other side, how you are trying to build together the right kind of sentinels to make sure that all this information is captured and you empower the customer with the right kind of investment decision. So, any interesting technology and business trend that you want to share in the next few years to come? From the investor's perspective and from the technology perspective as well.
Fantastic. So, first, I will take the investment perspective. There is a very big change happening as we speak, Mr. Nair. When I came into this industry 29 years back and I started observing things around me, of course, I was a freshly minted MBA at that time, and a lot of knowledge which we had was basically theoretical knowledge, which over a period of time we sort of adapted to the practical world and to the to the dynamics of the real world asset classes and real world economics. But one thing which has always pained me a lot in the Indian context, but also in the global context, was the conflict of interest. Most of the wealth management, for example, in India was happening through the mutual fund distribution route till a few years back. I used to suffer the pain when I used to see that people are putting their clients' money or advising them to put their money into 3 year, 5 year, 7 year lock in funds when the same theme was available in a product which had no lock ins, no exit clauses, and which had much lower expense ratios. But they were going to the former with higher expense ratios and higher lock ins because they were able to walk away with higher commissions. So I think the best thing that has happened over the last few years is the emergence of this investment advisory model in India and also in many parts of the world, whereby the investment advisor cannot take any third party commission or remuneration, irrespective of what the product is. Today, investment advisory is the fastest growing part of the Indian wealth management piece. They will give a very small percentage of their total assets which they give to a certain advisor as the annual fees, and there is going to be no remuneration which they can draw from the third parties. This has removed the conflict of interest in a very big way, but I still have to accept that it is still the mutual fund distribution route is a much larger piece compared to the investment advisory route. But I can very safely say, Mr. Nair, that over the next 5 to 10 years, you will see that change happening. People are becoming smarter. Investors know about this conflict of interest, and they know that in the mutual fund distribution model, your interests are misaligned with the interests of the distributor. As far as the technology is concerned, I think that has actually made lives very simple, both for the wealth managers and for the investors. Today, you've got technology tools whereby a wealth manager need not have a huge operations team. They need not have a huge team which is just catering to different requirements of the investor. Technology has come in, and how this has helped the investors is that this has reduced the possibility of an error. This has made the process seamless. It is effectively a 24 by 7 back office and not limited to the working office hours of the wealth manager. The whole process has become so easy. So, compared to the times that I have seen in my 29 years, I think today an investor's and a wealth manager's life is a lot more simple, a lot more automated. So, both of them can actually focus on the wealth creation part rather than being bogged down by the sheer logistics and the operational aspects of the entire exercise.
Superb. I think that was a wonderful encapsulation of bringing together both the business and technology aspect. And one of the important things that I have also noticed is probably the kind of reduction of personal bias of the advisor into the entire wealth management. Thank you very much for a great and insightful conversation with us.
Thank you so much for giving us this opportunity, Mr.
Thank
Nair.
you.